Well, despite terror attacks around the world, a White House under siege by an avaricious press corps, and policy gridlock on Capitol Hill, markets pretty much are holding steady, still breaking or close to breaking all-time highs. So why? Joining us now is former economic advisor to President Reagan, economist Art Laffer. Art, you're a supply sider. I'm a supply. We desperately want tax cuts, and we're not getting them yet. But I think the markets are less concerned about what we're not getting and more concerned or more happy about the fact that we're not getting anti-business stuff every day like we did during the Obama administration.
Is that not true? That's the complete truth. I mean, Obama was kicking the economy, beating the economy, hitting it, knifing it, banging it, poisoning it. I mean, all of this stuff he did there during his 8 years in office. And by the way, W wasn't much better either, just to be honest with you. I mean, the stimulus stuff and just stopping that horrible stuff, just stopping it cannot help but make the economy bounce back, the stock market bounce back. It's really an elixir right now, and frankly, I think Donald Trump has a very low bar when it comes to the economy. I think he's going to way outperform what people expect, even if we don't get the tax cuts right away or Obamacare eliminated immediately, which I would love to see.
But you don't think, you know, a lot of people were saying a month ago or even a couple of weeks ago that the market was set too high. The market is based on tax cuts already cooked into the market numbers. I don't think so, because I think that the market realizes they don't have an anti-business president. This guy's a businessman. He wants to help business. He won't do anything to hurt business, and that's the reason why the market is high.
Well, that is very much the reason why the market's high, although I do expect he'll be successful with tax cuts. Maybe not this year, but he will be successful. And I think as far as the economy goes, very much, David, he'll be an enormously successful president. And I think the Democrats are really worried about that, because 2018 will not be a good year for them if the economy really comes roaring back.
Okay, but let's bring it back to investors. Investors will be very happy if what we're saying is true. That is, if the market is based now not on expectations of a tax cut, but just on expectations of having a president that's pro-business. If we then get the tax cuts on top of that, the market could go through the roof.
It will go through the roof, I believe, because I really think once you start getting this ball rolling, David, it's really hard to stop it. There's a lot of momentum in a good economy. And, you know, already, I don't know what the markets are up. You guys publish that number every minute, but it's been up like 15% since Trump took office. And if you look at these markets, the markets are not overvalued. They may be the highest they've been, but, you know, they aren't much higher than they were in 2000, to be very clear on that. We have a long way to go to get to be a normal market. I think we have a long positive market.
Even if, Art Laffer, the president only gets, let's say, half of what he wants, that is, the tax rates come down half as much as he wants them to come down, would that be enough to push the markets higher?
Oh, yeah, it will. And once they start going, David, I mean, if I can tell you with Reagan didn't really get the tax cuts done until 1986.
True.
I mean, we got some of them done in 1981, and they took effect in 1983. But we got the real ones done in 1986, and the markets just kept going and going and going and going.
Right.
During that period of time, from Reagan to Clinton, I think the markets were up 771% in real terms, 1,380% in nominal terms.
And federal revenues doubled. Federal revenues doubled. The tax rates came down and the money came in. Art Laffer, we got to leave it at that. Great to see you, my friend. Thank you.
It's great to see you, David. Thank you for doing such a good job.